help you to measure the power of the trend and the strength of the trend using RSI. Then as we go on, we'll discuss powerful trading setups and the biases that we need to avoid while we trade with RSI. All right. So let's begin. So first is introduction to momentum indicators. What are momentum indicators and introduction? No sound. Am I audible? Yeah, I am audible. There is something on your part, you have to check it. Okay, momentum, introduction to momentum indicators. What are momentum indicators and how we use it? Now what momentum indicators does, it measures the rate at which prices rise or fall, right? It is a derivative of the price and it measures the rate at which the price is falling or rising. That means it measures with a comparison, right? That is, it will measure the fall and the rise of the price in relation to some prior falls, some prior value. So it will measure the rate, not the actual price rise and fall, but the rate. It is the first derivative of price, that is a calculation is used and it directly derived from the price. It is not the price itself. So every momentum indicator seeks to confirm the direction of the trend. When we use momentum indicator, we are looking for trend direction confirmation to discern whether the market is becoming overextended. That is, we have to see whether the market is becoming overextended in a single direction. That is, if the market is going up and up and up and up, it needs a correction, a healthy correction to move up again. So indicators and momentum indicators tell us whether the market is extended, is in an direction that is overextended or under in a single direction on the upside or the downside. It is called overbought and oversold levels. That is, if the market is overextended on the upside, that is overbought, and on the downside it is oversold. So like Nifty nowadays, if you see our stock market, it is overextended on the upside right now. So it is an overbought condition, right? And if you see the IT stocks and the pharma stocks, they are overextended on the downside and it is an oversold market, right? Means there are more sellers are more dominant in IT, pharma and USD INR, whereas in Nifty, banks and real estate, realty, the buyers are more dominant. That's why it is becoming overbought. And it is and momentum indicators are also helps us to spot any misappropriation between price and momentum, right? If there is any difference between price and momentum, right? Misappropriation means whether the price and momentum are moving together in tandem. Whether if there is a misappropriation, like price is moving and momentum is not supporting, then it helps. The momentum indicator tells us that the rate of increase of price is like have decreased or has lessened from what it was before 14 days or before 7 days, anything else. How it helps us to confirm, how it helps us for the confirmation of trend. So Newton's first law was a trend once started tends to remain in motion in a straight line, right? It was Newton's first law in motion, that if a trend starts, it tends to remain in motion for some time. Market falls and momentum settles into an oversold territory as market build base. Prices rises, but numerous falls start, keep participants unsure, right? It means that once a downtrend is started, it remains in force for some time. Then it will start making base. Now when it is making base, the prices are rising and falling, rising and falling. Suddenly from falling, it has started rising and falling, rising and falling, rising and falling. So it is making the participant participants of the market unsure whether this downtrend will continue or whether it has stopped. Now it makes a level here. It creates a level here. When it falls and this happens, so it creates a level here. Right? Now what happens if these key market levels are broken on the upside? The price move higher, confirmed by the momentum indicators. Now when it has made a base here, a base has been made here, and this base, as the price is moving up and down, suddenly it will break this base and the prices will move higher. Now the momentum indicators that were in oversold areas will start coming up to the neutral areas. So this price break will be confirmed by the momentum indicators. Right? The key market levels are broken on the upside, prices move higher, confirmed by the momentum indicators. Prices post higher highs, but momentum slackens off as the prices are not rising with the same speed, and momentum gives us pre-attemptive signals. That means now the base is made and the prices are rising high, so does the momentum. Now the prices are making higher highs and higher lows. And suddenly the momentum indicators were also rising with price. Now the momentum indicators started slackening. Now this tells us that though the prices are rising, the momentum is not supporting and the prices are not rising with the same speed. Suppose on this leg there was a movement of 10 points. Now there is a movement of 8 points, there is a movement of 6 points, and there is a movement of 4 points. So we are getting higher prices, higher highs and higher lows. But see the rate, 2 points less, 2 points less, 2 points less, 2 points less. Though the prices are rising high, the momentum is not supporting. So it gives us a pre-emptive signals that the trend that is in place may change or may remain sideways for some time before moving up again. So this is the excuse me, very important and very good signal that momentum indicators gives us, right? The disadvantage is even though the market are posting higher highs, momentum slows and it may attempt us to exit trade too early. Now what happens that even the market are making higher highs, the momentum shrugs, and what happens, this may gives us a psychological barrier that yes, the momentum has fallen down, now we should exit our positions. Now as I have mentioned before, that falling of momentum does not mean that it is a trend change. It may happen that the market may keep rising higher. First it may move sideways like this and then keep rising higher. So if you are following this momentum, what it happens, it gives us exit from the trade too early. Momentum weakening indicates that the prices are no longer rising or falling as they were before. It does not simply mean trend change. Exactly what I just explained. It means that the rise of the prices are not as before. That here it was 10 points, here it was 8 points, then here it was 7 points, here it was 5 points, now here it is 4 points. Though it says that though the market is moving higher, but the rate is slow. Now what will happen? Here the momentum is high, here the momentum is high, and suddenly here the momentum goes lower, here the momentum goes lower, here the further goes lower. Now from here to here you have taken a good move, but at this point you exit because the momentum has slowed down. but you still see that we have made 2 or 3 highs again. So the momentum is falling. It does not mean that the trend has simply changed. It means that the rate of the speed of the price rise or fall has lessened or reduced, or is not as it were before. Now, how to overcome this? Direct analysis of the chart of the market prices, whether based on trend analysis of pattern indication, make it precedence turn over a momentum. That means that when we are following a momentum chart, suppose this is an RSI chart, we see that the prices are making higher and suddenly it start making lower. We have to confirm it with a classical chart pattern. Suppose at this level the prices are going higher, and suddenly we post a lower high. So here we see the momentum has shrugged, and here the price also confirms it. At this point, when we mix it with our classical charting techniques or any other confirmation method, then it will tell us, yes, the momentum has really changed, or there is maybe really change in the trend. Okay. So how momentum indicators help us in recognizing the trend change, and then everything is clear. Now we move how momentum indicators help us to what is overbought and oversold and how we can read it with momentum indicators. So market is termed overbought when the prices have been trending higher relatively in a steep fashion for some time, to the extent that the number of participants holding positions, long position, outweighs those on the sidelines or holding short positions. That means there are increasingly fewer participants left to jump back on the uptrend. Now what happens when the markets are oversold? That there are buyers, and the buyers are more in number. Suppose with every rise we get a buyers increase, at 10 buyers, 11 buyers, and then here we get 12 buyers, then here we get 8 buyers, then here we get 6 buyers, right? So with every move the number of buyers increase up till here, and the person who are sitting on sidelines are less. Suppose here at this point the person sitting on the sidelines are 8. At this point the person sitting on the sidelines are 7. At this point the person sitting on the sidelines are 6, and at this point the person sitting on the sidelines are 10, right? So the person sitting on the sidelines increases and the bias decreases. So that means there are very fewer participants that are left to jump back onto the trend. That means with every high we get less participants who are ready to jump into the trend, and at this point we get that the momentum is getting overbought. That is, suppose it is an RSI, we have 70 here and we have 30 here, and here the RSI crosses the 70 levels, and at this point it breaks the 70 level. That means the RSI has become overbought, the momentum has become overbought. That means there are very few participants left in the market to buy. So at this point the market becomes overbought. Similarly, yes, there is a chart. So suppose here the RSI touches 70 at this point. That means very less participants are there in the market to buy, and the price correct. Again the price rises and it touches 70 again. That means again here the fewer participants to come into the trend, and the prices started falling again. And again prices rises, again we hit the 70 levels, and again we see that there are very fewer participants to buy the trend, and again the prices fall. So at this point where there are very few participants left on the buy side, we get an overbought condition. Similarly, just the opposite, the market is termed oversold when the prices have been trending lower relatively in a steep fashion for some time, to the extent that the number of market participants holding short positions significantly outweighs those on the sidelines or holding long positions. This means there are increasingly fewer participants left to jump back onto the downtrend. Same thing. The market is falling down and suppose there are 30 participants, 5 are sitting on the sidelines, 10 have long positions, they are sitting on the sidelines, 10 have long positions and 15% people have short positions. Now as the market have started falling, here we were 15%, 15 people were having short position, 15 people were having short position, here suddenly 12 people are having short positions and here 10 people are having short position. So people on the sidelines and long side increases and people on the short side decreases. Now that means that there are increasingly fewer participants left to jump back onto the downtrend. That means at these levels, at this level, very few people are wishing to short the market, right? So this is called an oversold market where sellers, number of sellers become very low. So in the case of RSI, when we have 30, it is oversold, very less sellers. So market goes up again and then again come down. So here again sellers are very less. So market goes up again come down, sellers are very less. Market goes up again come down, again that means sellers are very less. So it carries on. Alright. So thus overbought and oversold predict a turn. This is a very important question. The mere fact that the momentum indicator is an overbought or oversold territory does not in itself signal an exit the trend or following trend. That means whether the indicator moves into an oversold area, suppose it moves above 70, that does not mean that the indicator has turned overbought. That does not mean that the following uptrend has come to an end. It just means that the sellers have become less, means there has been profit booking and people have started making profit, and so we may see a correction downward, and then as we move down the sellers will sell every rise and suddenly the sellers will increase more, the buyers will buy every dip and suddenly at this point the buyers will outnumber the sellers and the price will start rising again. So it will move from overbought to maybe neutral area and the RSI will move up again. So overbought and oversold does not predict a trend change, right? It is not in itself a signal to exit. The mathematical construction will lead most of the indicators to enter overbought and oversold territory when the market is in a strong trend. So when you are talking about an oscillator or when you are talking about a banded oscillator, you will see that there is a mathematical, it is banded, it is so calculated to move between 100 and 0. So once the market are making higher high and going up, this indicator, how much it tries, it cannot cross 100 because it is curtained by the mathematical formula that it will resist at 100. It cannot exceed 100 at any cost. So that means that it is constructed in such a way that it cannot resist, it cannot cross 100. And that does not mean that it is, if it is not crossing 100, that does not mean that it will come down. Right? And RSI is a indicator that is constructed in a way that as the value will increase, that is as it will start going through 70 to 80, right? Even a small correction in the market will lead the indicator to fall more because it is constructed in such a way. So it does not mean that this correction is a trend change, right? So let us see. Here market got overbought, oversold at this point. And does it mean the trend was changed? No. It came here and fell down again. Again here it got oversold, sorry. Does it mean that the trend has changed? No. It comes down and falls again. So getting overbought or oversold does not mean the trend has changed. There was a fall in the market, the prices were following down and down, and the market was consistently moving into an oversold area. That does not mean that moving into an oversold area means a trend change. That means if market moves into an overbought and oversold area, it means that there may be an upside or downside correction and the major trend will resume, right? To make it very simple, you can remember it like this, that oversold means many people are selling and overbought means many people are buying. As simple as that. So here you can see, here the prices become overbought, and then again we made a new high, prices become overbought. Again we made a new high, the prices becomes overbought. Overbought, profit booking, new high. Overbought, profit booking, new high. Overbought, profit booking, new high. So overbought and oversold does not mean the trend has changed. It means it is a continuation of the trend. It just may be a healthy correction that may be coming, or a profit booking that may be coming, but it does not indicate any trend change. Now one more observation if you can make here, that every time the market have become oversold, the prices have posted new lows. And every time the market has become overbought, the prices have posted new highs. So whenever you hear any technical analyst or any big technical guru telling that the market have become heavily overbought or heavily oversold, it is the right time to enter on the long side or a short side, just ignore that stupid. And keep in mind one thing, that overbought means many people are buying. You should utilize the corrections to enter long, and oversold means many people are selling, and you should utilize the upside corrections to add to your shorts. All right. So see one more case, ACC daily, overbought, 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 and a new low every time. Here we get overbought again and a new low every time. So every time we get oversold, we make a new low. And people say that oversold markets are markets that are ready to buy. No, why you would buy an oversold market? Instead, I will wait for a correction and short it here. Again, I will wait for a correction, I short it here. Again, I wait for a correction, I short it here. Oversold means many people are interested in selling. The big guys are selling. Adani Enterprise, every time the market becomes overbought, Adani Enterprise posts a new high. Just look at the beauty of RSI and how it says. Every time the market becomes overbought, it posts a new high. Overbought, new highs. Overbought, new highs. So, even if you trade with this funda, you will make money. You don't need to learn anything else. and we have not started RSI yet. I'm just giving you an introduction about the momentum indicators. So divergence. Now let us see another feature what momentum indicators tell us. Divergence, bearish divergence describe a situation in which the market continues to trend up, but the momentum indicator is heading down. That means the market is moving up and the momentum indicator is moving down. So this is bearish divergence. Bullish divergence is describe a condition when the market trends down but the momentum indicator is heading up. That means the market is falling and suddenly the momentum indicator is not falling. So this is a bullish divergence. Simple. So here is the bearish divergence. The market is making new highs, but the momentum indicator is not making a new high. The markets make higher highs, the momentum indicator make lower highs. It's the bullish divergence. Market continuing down, making new lows, but the momentum indicator does not make a new low. It makes a new higher low. It's a bullish divergence. So here is Oro Pharma. Market makes a new high. RSI makes a new low. Higher low. A bearish divergence. Axis Bank, same case. New high, higher low. Market is in a downtrend. We get a bullish divergence. Market is making a new low. RSI doesn't make a new low. It is bullish divergence. Same case. Market makes a new low. RSI doesn't make a new low. Bullish divergence. Simple bullish divergence. Divergence tells us that although the trend is still intact, as evidenced by the move to new high or new low, the speed of rise and fall is lessening. So the same thing, divergence tells us that the downtrend is still intact, but when you see the divergence, the speed of downtrend or the speed of uptrend has lessened. It does not tells us or it does not indicate a trend change. It just tells us that the speed has lessened of the ongoing trend. So divergence frequently precedes a trend turn as some sort of top or base building. It is best to look for confirming pattern forming in our price chart as well as momentum divergence in the indicator. This is a good warning sign for raising our protective stops. As it may be precursor to market turns. Now when you see a divergence, you have to do two things. First, you have to look at the price patterns. Anything? By price patterns, I mean this is the price chart and this is the momentum chart. So when you're looking at a divergence here, you see a double top almost. You see a divergence here on the RSI and you see the double top has been confirmed. That means then it will only be a true divergence. Otherwise, it just tells us that the speed is lessening and we have to raise our protective stops. We have tightened our stops because it may or may not predict a market turn. So divergence tells us the speed of the rise or fall is lessening and we have to use it with the price patterns, with other confirmation tools to see whether the divergence is true or false, and if it is true, we have to raise our protective stops. The price action is more important than the indicator action. Same thing. If you see, this is Asian Paints and there is about a continuous divergence here, but the market was not obeying the divergence and it was making new highs every time. So divergence was not given any heed. So that is why I was telling a price confirmation is important when we trade divergence. Just not like that, you see a divergence in Nifty, you see a divergence in Bank Nifty, in BRAM you go short. No, it's not like that. We have to wait for the price confirmation to see whether a divergence is true or the divergence is false. Similarly in SCL Tech, you see the divergence is there, but the prices are making highs. Divergence does not mean a trend change every time. We have to use price patterns along with it to see whether the trend have changed or not. DLF have a bullish divergence, but no, it does not mean the trend has changed. It came down again. We have to use price patterns. If there was a triangle here, or there was a double bottom here, or inverse head and shoulder here, then we would have considered that it could be a price change or something like that, not before that. Dish TV, same thing. You see a bullish divergence, but it does not mean a trend has changed. So price action is more important than in the indicator action. So the popular indicators and oscillators are stochastics, relative strength index, the CCI, commodity channel index, the Williams percentage R, the TRIX, the ultimate oscillator, the Harun indicator, and the ROC. These are the most popular and most widely used indicators in technical analysis. Alright, if you are doing technical analysis and if you are already a trader, you must have come across all these things. If not all these things, maybe 80% of these things. And I'm very sure that you must have tried it also on the charts. So what is multicollinearity? Multicollinearity is a statistical term for a problem that is common in technical analysis. A very common problem in technical analysis, that is when one unknowingly uses the same type of information for more than once. Analysts need to be careful and not utilize indicators that reveal the same type of information. That means we are using the same type of indicator. We are using ROC, we are using RSI, and we are using percentage R, we are using CCI, all at the same time on the chart. These all four indicators tell us the same thing. They do not tell us the different thing because the mathematical formula is almost same. They tell us the same type, they give us the same type of information. So we have to be very careful that we should not utilize same type of indicators and same type of tool in our trading. An example would be using many indicators that portray momentum. Like RSI and ROC together does not make any sense as both are derived from the closing price. Instead, ROC and stochastic will make sense as stochastic will include range into analysis. Similarly, MACD can also be employed as the trend following capabilities. So when you are using RSI and ROC, it won't help you because the calculation includes closing price. On the other hand, stochastic includes the range of the price. That is, stochastic includes the high and the low. So it is looking at a different thing. ROC and RSI includes the close. So they are looking at the same thing. The mathematical formula is almost same. So if you, and even the CCI looks at the close, the percentage R looks at the close, everything they are looking at the close only. So using these three in conjunction won't help. Rather, you can use stochastic, you can use RSI, because different variables are included and used in their calculation, not the same variables. Similarly, MACD is used for trend following. Now, when we, especially in my advanced course, technical analysis advanced course, I basically train on the 4 dimensions that market works upon. First dimension is the trend. We have to find the trend, what is and where is the market trending. For it, I use the MACD. It tells me about the trend. Next is the momentum. It tells me about the momentum, how the momentum, whether the momentum is supporting the trend or not. It should always support the trend. Whether the momentum is supporting the trend, then we are saying that yes, the prices will move up and down because the momentum is supporting. When the momentum starts not to support the trend, we may say that there may be a correction. So I use RSI for momentum. Then the third aspect is volatility. We have to look for volatility. How is the volatility playing in the market? We have the trend, we have the momentum, but we don't have the volatility, then the price will not move. So third is volatility. The fourth is confirmation. Now we have the trend, we have the momentum, and we have the volatility. We need a confirmation to confirm all these things are true. And for the confirmation thing, we use price action, and I use candles for confirmation. So these are 4 dimensions of the market. Another dimension is time, and I use RSI for time also. I have made RSI cycles. That is a very advanced study. But if you are trading for yourself, and if your goal is not to trade big money for portfolio management or for HNIs, then learning these 4 things deeply would be enough. But if some big money is involved, then see how RSI, there is a question how RSI measures volatility. That is outside the preview of this course. But if you have just raised this question, I'll just show you one chart. This is an volatility chart. This is an volatility chart, and it has been derived in a way using RSI that tells me whether the volatility of the market is high or low. Now you can see that it tells me now the volatility of Nifty is very low because it is below 30. Right. That is this is outside the preview of this course. This is very advanced stuff, and this is a proprietary thing that cannot be disclosed to anybody. So let's continue. So here, if you see, I have used on this chart, I have used the RSI, I have used the CCI, I have used the ultimate indicator, and I have used the Williams percentage R. Now all these 4 indicators use closing price in their calculations, and all these 4 indicators are telling us that the prices have become overbought in this zone, and the prices have become oversold in this zone. All the 4 indicators tell us the same thing. This does not mean that when the RSI is telling us the price have become overbought, even the CCI is telling us the price have become overbought, the ultimate indicator is telling us the price have become overbought, and the Williams percentage R is telling us the price has become overbought. It does not mean that this signal is 4 times stronger. It is a wrong perception. It does not tell us that this signal has become 4 times stronger. No, it is telling us the same thing, that the prices have become overbought. That does not mean that this signal is 4 times stronger. No, this tells us the same thing. Every time it tells us the same thing, because the formula of these 4 indicators are almost same. If you just go and open the formula and search the Google, they are almost same. And similarly here, when it is oversold, the RSI tells us it is oversold, the CCI tells us it's oversold, the ultimate indicator tells it oversold, and Williams percentage tells us oversold. That does not mean that this is a very strong signal. All the 4 indicators are telling us the same thing. It doesn't tell us different things. So this is multi-collinearity. We fall in this trap. We see the same signals in same type of indicators, and we believe that the signal is 4 times stronger, and we go with 4 times our position because everything has shown us it is oversold. Now this market is going to skyrocket, and you go 4 times your position. When you are buying 1 lot, you will buy 4 lots, and you will get stopped out, and then you will say that technical analysis doesn't work. Similarly, when you see divergence here, if you see divergence here, divergence, 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 that does not mean that this divergence is 4 times stronger and market will crash. No. These tell us the same thing. Right? So please, when you next see, first of all, stop using 4 or 5 indicators. So I have made a category. Technical indicators should be arranged in the categories to keep using the same category, and you can refer this table. When you are using momentum, the indicator calculates the rate of change of price. So RSI, CCI, Williams R, stochastics, Strix, ultimate, Arun, and stochastic range. It calculates the range of change, rate of change. They are calculating the same thing, rate of change. They are not calculating different things. Similarly, for trend, when you are using, they are based on moving averages, and MACD, ATR, ADX, DMI, price oscillator, they are all based on moving averages, and these all tell us the same thing. That is, they tell us about the trend. This does not tell us that the trend is 5 times or 4 times stronger. No, it does not tell us this thing. They tell us the same thing. So you can pick RSI from here, you can pick MACD from here if you want. Similarly, when you're using volumes, it tells us about accumulation distribution. So the Chaikin money flow, the volume RSI, volume oscillator, demand index, on balance volume, money flow index, they tell us the same thing. That does not tell us different things. So when you see a volume burst in the Chaikin, when you see a Chaikin, when you see a volume burst in ROC and everything else, don't form a view that this volume burst is 4 times or 5 times stronger and this thing will shoot up or shoot down, something like that. All right. So here we come to an end of what is about indicator and oscillator thing. What is indicator and oscillator? Here we come to an end of the thing. And now we will start with the RSI. So the RSI. A small introduction that it was developed by J. Wallace Wilder Jr. in late 70s. In his book, New Concept in Technical Trading Systems. If you have not read this book, you should go and read this book. You should purchase this book and read it. It is a very good book, and there are lots of things that you can learn from this book. And RSI measures the speed and the change of price movement. It oscillates between 0 and 100. Wilder considered markets to be overbought when above 70 and oversold below 30. That means RSI levels 70 for overbought and 30 for oversold. And he's generally looked for divergence, failure swings, and centerline reversals. This is how Wallace Wilder Jr. used RSI. He used divergence, failure swing, and centerline reversals to trade with RSI. RSI is extremely popular indicator and has been featured in number of articles, interviews, books over the year. Andrew Cardwell used the indicator in a very unconventional way and introduced altogether new set of rules and signals and have enhanced the use of RSI. So if we can say that if Wells Wilder Jr. has given birth to RSI, Andrew Cardwell have nurtured it and made it young and grow and start rocking. Just like our own Indian god Kishan Kanhaiya. The birth was given by Devki and he was brought up by Yashoda. It's the same thing like for RSI. So let's do the math. So RSI is based upon the observation that prices tend to close higher when the trend is rising and tend to close lower when the trend is following. It is very important to know the math because when you are using an indicator, you should know how the RSI is constructed and why you are looking at RSI and what RSI tell you. So basically RSI is made in such a way that it takes a funda in its calculation that when the prices are moving higher, right, the price every time should close near its highs if the prices are moving higher, right? And when the trends are lower, the price close should be towards the low of the day, right? So if on the first day the price close is 80, on the second day the price close is 85. So it would compare this close with this close. So it is closing near the high. RSI utilizes only the closing price and not the daily range. So even if you use a line chart in RSI, it will be sufficient for you. If you want to trade on RSI only, you don't need to plot the open, high, low, close or candlestick chart because it only utilizes the closing price. Okay, is the audio breaking now? Am I audible properly? Just a moment. Am I audible properly now? Okay. Some lag in the internet maybe. So RSI compares the average rise on the up days with the average fall on the down days. That means on the up days, still there is an audio issue. Kya? Has the audio issue resolved? So just give me a moment. Just a moment. Is it okay now? Is it okay now? Okay, thank you. So it compares the average rise on the up days and the average fall on the down days. That is how much the price have rose from the previous day's close. It takes the average of the up days in relation to the close of the previous day and it compares it. Suppose average rise. Suppose today the close is 20, next day the close is 30. So 10 points is the close difference above. Next day the close is 45. So it is 15 points. So it will compare the average of these rise up days. Similarly, on the down days, it will compare the average of the down days. And then this comparison is expressed between 0 and 100. That is, it is made as a ratio between 0 and 100 and it is bounded by an formula. That is, it has to stay between 0 and 100. And the standard practice is to use a 14 days RSI. That is the standard practice that has been maintained or that has been written in the book. Now, why we use a 14-day RSI? Is there any logic? Mr. Abhishek ji, you won't answer this. Is there any logic why we use a 14-day RSI? Why? Because Wells Wilder has told us what he has written. Is it true? Why we should use 14-day? Is there any logic? Can Naresh ji and Lalit ji just tell me that? Is there any logic why we should use? Why we are using 14 days? It's not because Wells Wilder tell us. Just tell me the logic. If you just know, I'll be happy to get some answer. Lunar cycle is the correct answer. It's not the full lunar cycle, it's the half lunar cycle. The full lunar cycle is 28 days. It's not the trading week, sir. If the full lunar cycle is 28 days, the half of the lunar cycle is 14 days. So Wells Wilder took the half lunar cycle, right? But there is one catch in it. For daily charts, 14-day RSI is okay because we are looking at the half lunar cycle. Then why we will use 14 period RSI on the hourly chart? Why we use 14 period RSI on the weekly chart? And why we use 14 period RSI on the monthly chart? This is a homework for you. Go and find the answer. So the 14-day RSI is calculated on this formula. Relative strength is average gain by average loss. That is gains on the up days and loss on the down days. Both are average and they are divided with each other. The average rise on the up days of last 14 days by the average down of the fall of the last 14 days. That means on the average days, the prices have risen. In the last 14 days, it has been taken, and the average fall in the last 14 days has been taken, and these two are divided with each other. We get the relative strength. Then the average rise, the total number of points. I just told you like that. Average fall is total number of points 14 divided by 14, right? So we get the relative strength, we get the average gain, and we get the average loss, and then it is put in this formula to get an RSI, right? So RSI is used as an overbought and oversold signal. Measures momentum, allow us to estimate the speed in excuse me, speed in one direction is overdone. Now RSI tells us that maybe the speed of the trend in one direction is coming to an end for some time, or there may be a halt in the up move, and the speed may lessen or it is overdone and we may see a correction. Similarly, overbought and overzones signals are identified on the oscillator charts, and these are the points where price move and may hit some price extreme. So if we see that the prices are moving at 70 and coming down again it's moving at 70 and coming down again, it's again moving at 70, coming down again. So at this type, at the point 70, we see and we make an observation that every time the price is hitting near 70, the price is repelling down, and also the indicators are repelling down. So we make a 70 as an overbought zone. Similarly, we see that whenever the price is hitting the 30 area, the price is repelling upside and it is creating an oversold zone. Similarly, in this two ways, we can see the price. Similarly, the overbought and oversold area has been marked in this way. We see an extreme that at this extreme the prices momentum stops and prices falls down. At this extreme the momentum stops and prices rises. So we make an overbought and oversold area, keeping in mind these extremes. So this is how the area is determined, right? So when we see that the RSI is not going beyond 70 or it's not going beyond 80, then in that way, what one thing that tells us about RSI, that RSI is of cyclical nature. The overbought and oversold zone are found in cycles. All right. So the time cycles I was telling you about. So RSI can be used for cycle studies. Here are the RSI cycles. This is the RSI cycle. This is the RSI cycle. It is again a proprietary study. Andrew sir has not taught me this. This is my own invention. The RSI cycle is my own invention. Similarly, RSI volatility is my own invention. No one has taught me. Alright, just to show you what RSI cycle is all about. This is the long-term cycle, this is the short-term cycle, and this is the RSI cycle. We'll talk about this later. So according to Wilder, when the RSI reaches the 70, the markets are overbought and prone to correction. When the market reaches 30, they are oversold and ready to move up. So first question, how did it arrive at the 70 as an overbought and 30 as an oversold area? Right? What did he see there? As I have explained you before, he saw that often when the market price, often when the RSI is reaching at the 70 level, the prices come down, and often when the RSI reaches the 30 level, the prices move up, and that has forced him, or that has that at that point he made an observation that maximum selling or profit booking takes place at 70. So he made an area of 70 as an overbought area, and he saw that maximum profit booking on the downside takes at 30, and so he made an 30 as an oversold area, and this is how he have derived the overbought and oversold area, right? There is a logic behind everything. It's not that it is written on in the book, it is 1730, and you should start accepting it, because there is a logic behind everything, and it is important for us to come to the logic. And why 14 periods is the default period, we have just discussed this, and you please find out why 14, if half lunar cycle is taken by Wilder-Wells, that is the real logic he has applied, half lunar cycle, then why we use 14 period on the hourly chart, and why we use 14 period on every chart, right? So this is just an overview of that. The shorter you will do the RSI thing, when you are changing the parameter of RSI or making it less, the 70-30 levels does not hold good, because you see here the oversold and overbought level changes, and it comes around 80 and 90. So the 70-30 levels of overbought and oversold remains true with the 14 period RSI only. And when you have changed the parameter of RSI, when you increase or decrease it, the overbought and oversold level changes. So keep in mind, when you are using a shorter period RSI, whether when you are trading with currencies or when you trade with bonds. Actually, in India, we cannot trade with bonds, and also currency trading is not so prominent and predominant. But when we were in US and when we were in Singapore, we were trading with currencies and bonds, and we were using this 5 RSI there, and the oversold and overbought levels, and so everything was changed. So how to deal, as I have told you that overbought and oversold levels generally does not tell us that the market have changed the trend. It does not tell us that once the market is reaching 70, that means that the trend has changed. It does not tell us that when the market have reached 30, the trend has changed and suddenly we will move on the upside. It does not tell us that. Rather, there is a way to deal with it. So you will ask me, sir, what is the way to deal with it? Because right now RSI on Nifty is above near 70, and what is the way to deal with it? So this section will tell you how to deal with oversold and overbought areas. So overbought and oversold areas in oscillators are zones where stock trend can be temporarily overextended. Right? There are temporarily overextended zones. Hence, pullback from the zones can be expected before the trend resumes. So when the stocks moves into an overbought and oversold area, we can presume that the trend is overextended now, and we can get a minor or healthy correction before the trend resumes again in the same direction. During strong trend pullback from overbought oversold areas, the RSI will halt near the neutral zone. The neutral zone is the 50 zone, where bear power and bull power is equal. So whenever the RSI is above 70, that is, it is overbought, it generally happens, it comes back and halts at 50. That is the neutral area, and the trend resumes on the upside. So giving respect to the 50 area. Similarly, when the RSI is oversold, it moves up and comes back and halts at the neutral zone 50 and moves down again. And the trend resumes downward again. That means the trend is down, it is in the oversold area, get a correction, RSI comes to the neutral area 50 and moves down again. And this is come down again. So it always comes, or sometimes it comes to the 50 neutral zone area from an oversold or overbought zone. right? Now pay attention. A rise or fall failing to take the oscillator reading into the overbought and oversold area is a sign of weakness in the trend or strength in the trend. A new push to the overbought and oversold area is a sign of strength, and the next dip on the rise is to be bought or sold. So let me explain what it is. Now, when we see this is RSI, suppose it is RSI 70 here and RSI 30 here. The trend is rising and this oscillator goes into an overbought zone here. It moves down again and touches 50 or touches near 50, comes back up and moves down from here. Now what has happened that this up move, it is not a divergence concept, okay? This up move in the security is not so strong that the RSI has moved back into an oversold area. That means it has not made an momentum high. Instead, it has made a momentum low. The power of the trend to move up is falling. That means this is a sign of weakness in the trend. If the respective or if the following move in the trend in an uptrend does not take the RSI again into an overbought zone, does not push the RSI into an overbought zone, that means that this is a sign of weakness. In a falling market, RSI falls and comes and touches 30, then RSI moves up, there is a pullback and it comes and again touches 30 or maybe lower, then it comes back again comes and touches 30 and lower. It's okay. That means every time the price is falling down, it is able to take the indicator into the oversold territory. That means with every fall, the indicator is going to an oversold territory. That means the predominant downtrend is very strong. Now suddenly and this time it does not fall to an oversold territory, and this happens. That means this fall is not so strong and it has not taken the oscillator to an oversold territory. That means the downtrend may be weakening. We'll see chart right now and you will be very clear. But I suppose the funda is clear. If there is a fall in the markets and the markets are falling, every time the RSI touches the oversold zone, that means the downtrend is very good, and once it does not touch the oversold zone, that means the downtrend may be weakening. So here, have a look at this. At point A, the prices are moving up. At point A, RSI moves to then oversold territory, then comes down and RSI moves to an oversold territory. Here RSI moves to an overbought territory at A and comes down and moves to an oversold territory. Now when the prices moves up, again this up move has taken the RSI into an overbought territory at B. That means this price move is strong strong enough to take the price to take the RSI to the overbought territory again. That means this price up move is quite stronger move. Then it comes down again, and again at C it takes the RSI to an overbought territory. That means this up move is quite stronger, right? Then again it falls down, and at D again it takes the prices to an overbought territory here. That means the price is stronger. This up move is stronger. Even when we are seeing a divergence here, but the following move takes the RSI to an overbought zone. That means this divergence is not a true divergence. The trend is still stronger on the upside. Then again we see a fall, and again at E. Now at E the RSI fails to move to an overbought territory. That means this up move was not stronger as it was at A, at B, at C, or at D. And RSI has failed to move to an overbought territory. Momentum has weakened, and we may get a correction. Am I making myself clear? All right. Similarly, here the price moved up at A, it moved up to the overbought territory, and again there is a correction, and at B the price failed to move back to a overbought territory, and the prices falls. That means here the momentum has got weak, and the prices falls and goes to an oversold territory at X. Now the prices rise up again and come down at Y, but at Y it fails to go to the overbought territory, oversold territory, sorry. At Y it is failing to go to the oversold territory again. That means the downside momentum here is not as strong as it was at X. So if you are in a short position, you get out of your short position, and it moves again to the overbought territory at 1. Then again it corrects, it goes to the overbought territory at 2. The RSI has gone to the overbought territory. Then again it corrects, it goes to an overbought territory at 3. The price action is quite strong, and then it corrects, and at 4 it fails to go to the overbought territory. Here at 4 it fails to go to the overbought territory. That means the up move here is not strong. A very simple momentum trading technique. Now for a downtrend, you see this is the 50 zone, and from an oversold territory price comes and reverses from the 50 zone. Then again it goes to the oversold territory, price comes and reverses from the 50 zone. Again it goes to the oversold territory, price comes and reverses from the 50 zone. Again it goes from the oversold territory, price comes and reverses from the 50 zone. and now again it goes to the oversold territory, but the price does not reverse from the 50 zone here. That means that this downtrend has lost its strength a little bit, and here the prices push to an oversold territory, overbought territory, and we can see that the trend has changed. So this was the neutral line reversal. Every time price travels to the neutral zone and the price is repelled back downside. So every time the prices are touching the oversold zone, the prices are making new lows, and every time it hits and repels from the neutral zone or neutral zone on the RSI, that is the 50 levels. It's not the rain shift. Don't jump the guns. Let everything be clear. You will come to the rain shift. This is a very interesting thing, and this is a base building type of thing. I am talking about a neutral zone of 50. Rain shift does not happen at 50. No one in the world will tell you these things. You can go and search the internet. You can go and search anybody and everywhere. No one can teach you like this. RSI momentum. I can bet you that. Just simple momentum technique, and you can trade momentum technique like this. No one heck in the world will tell you that momentum can be traded so easily and so effectively. It a bet. It is a bet. You cannot become a star trader on a weekend. You need not to pay for a star trader program costing rupees 75,000 or 80,000. Even you pay this there, you won't get these things. I can bet you. Please don't name anybody. I'm very sorry. He's a very good friend of mine. Yeah, no problem. But I have to give awareness. Awareness is very much necessary. Weekend programs does not make star traders. Well, let us not come back to our point. So this is a neutral zone. As I have explained in the last time, this is the 50 zone on the blue point, if you can see. So every time from the overbought area, 50 neutral zone, pull up. Overbought area, 50 neutral zone, up. Overbought area, 50 neutral zone, up. Overbought area, Nifty 50 neutral zone, up. Then the neutral zone has been broken and we see a good correction. Then again, overbought area, neutral zone, up. Neutral zone, up. Again, neutral zone has broken, a good correction. Overbought area and neutral zone, up. So this is clear. Everybody? Okay. So this brings us to our first trading setup. A rise or a fall failing to take the oscillator reading into an overbought or oversold is a sign of weakness or strength of that trend. A new push to the overbought and oversold is a sign of strength of weakness, and the next dip or the fall is to be bought and sold, and pullback will halt at the neutral zone. Let us see what it is. This is the first trading setup. So this was the first trading setup, that if a trend is going on the upside, and every push up takes the momentum indicator to an overbought area. So every dip near the neutral zone or near a support should be bought. It is the sign of strength. If every following move up takes the oscillator to an overbought area, so every dip from the correction should be bought, or any dip to the neutral area should be bought. This is the sign of a strong trend in the uptrend. Similarly, in a downtrend, every fall which takes the oscillator into an oversold area tells us that the trend is weak, and every reversal to the neutral zone of RSI, or every reversal to an resistance zone of the price, should be taken as a short. And once the neutral zone is crossed, either you can take profits here, book profits and move out, or you can tighten your stops. So this was the first trading setup. I hope it is clear. Our first trading setup, how to trade overbought and oversold. So if you need a break of 5 minutes, I can provide. If not, I can carry on. Shall I carry on, or we need a break of 5 minutes? Okay. 5 minutes break. It's 6:30. We meet at 6:35. Exactly 6:35. Okay, everybody in? We will resume. Everybody in? Abhishek ji, Lalit ji, everybody in? Okay, Abhishek ji. Abhishek ji, are you in? Okay, let's begin. So now we'll start our range rules. So range rules were developed by Andrew Cardwell sir some 35 years ago. And what he observed that security has different character when it is in the bull phase and it is in the bear phase. That means when when a stock is in a bull phase, then RSI have a different character, and when the security is in a bear phase, the RSI behaves in a different way. So what he did, he framed a range rule, and he said that the normal range that was observed by Wells Wilder was 70-30. And he observed that there is a shift from the above levels and market changes character. That is, when the market is changing its character from a bull phase to a bear phase, there is a shift from the normal range of the RSI. What he observed. Now, what he made an observation, and what he noted down, that the public range that is known to everyone was 70-30. Now, when the market is in a bull range, that when we are making higher highs and lower highs and the momentum is supporting, then the overbought levels becomes 80 and the oversold levels become 40 when the market is in a bull range. And when the market is in a bear range, then the overbought levels become 60 for it and the oversold levels become 20. So in general, overbought and oversold levels becomes 80 for the bull market and 20 for the bear market. So there is a range extension by Andrew sir. No more 30-70, but now 80 and 20. And this is 40, this is 60, and this is 40. So when the markets are in a bull phase, when the market are in a bull range, that is the market are in a bull phase, at that time 80 will be oversold area for the market, overbought area for the market, sorry, and 40 will be the oversold area for the market. That means the prices will reach 80 levels and then come back down, touch the 40 levels. So it will go up again and touch the 80 levels, come down to the 40 levels, like this. So what he observed, that in a bull range, the overbought area becomes 80 as the RSI moves to 80 many times, and it does not break the 40 level generally, and the market moves from the 40 levels of the RSI. So oversold levels become 40. It does not generally goes to 30 or 20. So when this happens, that the market is oscillating between when the markets are going up and the RSI is oscillating between 80 and 40, we can presume that the market is in a bull range. The market is still in the grip of bulls. Similarly, what happens when the market is in a downtrend and the RSI is oscillating between 60 and 20? That means the market is in the range of the bulls. That means the market has been gripped by the bulls and we are following 60 as an overbought level and 20 as an oversold level in the bear market. So there is a shift in the character of the RSI. RSI changes its character with the markets. The oversold and the overbought, the traditional oversold and overbought levels of 70-30 changes to 80-40 in a bull market and 60-20 in a bear market. Okay, so this is an example of Tisco. So it was a bull market. On this side you can see, excuse me, on this side you can see it was a bull market, and at A point RSI turns from 40. At B points again RSI turns from 40, does not break 40. At C point RSI takes support at 60 and moves up, and at D point RSI again does not break 40. So every time RSI was taking support on the 40 and 60 levels and the prices were moving up. That means it was a bull market and RSI has shifted its range from 70-30 to 80-40. Now at this point the momentum failed to, the price failed to take the momentum to the traditional overbought area, that is 70 area, and we can understand now that the market is going to change and we see a range shift. Now here the prices are not even able to cross 60. Now from 80 to 40 suddenly we are halting at 60 and the prices are not able to cross even 60. Then there is a fall and again the prices comes and halts near 40. Then again there is a rise, but this rise does not lead the RSI to cross 60. Again it gets stuck on the overbought zone in the bear market, because in the bear market the overbought zone is the 60 zone, and again it comes down at H, again it gets stuck at the 60 level and then it moves down, again it gets stuck here near 60, again moves down. So there is a range shift suddenly from bull zone to a bear zone. This is called range shift. Similarly, crude oil, here the momentum I have marked 80 and I have marked 20. This is 60 and this is 40. So here the momentum failed to go back to the oversold zone at 70. So we get an inclination and we get an indication that it may happen that the market may start falling and the prices start falling here. Now at B, the market is not able to cross 60. Right? So we see a range shift, and this is an example of real trade that we took in crude oil at that time. We were trading for a very big man in Gujarat, and we sold crude oil here I just remember. And he called us and told us that we have gone nuts because everybody and everywhere there were news that crude oil is gonna shoot up. There may be war, there may be depression, anything. And why the heck we are selling crude oil? I was selling crude oil because I saw this. This was enough indication for me to sell crude oil. And then this level broke and it moved down. And again it came and resisted at 40. Now the crude oil has become so weak that even it is not even able to cross 40 levels. That means at point A, because I wanted an extra confirmation, this was not an confirmation of range shift. Range shift gave me a very good confirmation. I would have sold it at point A also, but it would have been a very aggressive entry. But at point B, it was a very confirmed entry. So at C, it was so weak that it even crossed 40. Again, it went down, and at D, again it resisted at 60 levels that act as an overbought area in the bear markets. Then again it came down, and here at this time it was not been able to take RSI on the bearish on the oversold zone, and it moved up, and then it came and it resisted at 60 again. Now see, this is an important thing. It moved to an above area, that is it moved above 60 and then came down, and then it resisted at 60 again. That means this move up was a mere correction. It was not an trend change because the momentum was not so strong that it didn't take the price to the overbought area again. Now see, everything is connected. Why I was putting more emphasis on this momentum study. Here it went over 70 area, it came down, and now it didn't even touch 70. It told me, it gave me enough evidence that the momentum was very weak, and even it didn't cross the previous it didn't carry to the overbought area, and again with that it resisted at 60. That is an overbought area for the bear market, and the prices was down. It's nothing like that we need 2 points confirmation for range shift, nothing like this. It's just a matter of an aggressive entry, and it is just a matter of an confirmed entry. If you are happy to leave so much point on the table, it's all right. I am happy to leave. Even I would be more happier to enter here. Why I would be more happy to enter here? That is a part of our advanced course, and we'll discuss there. Now in the Oro Pharma, here from 2020 levels, RSI went up and took support at 40. So here it was a range shift. Then it went to the overbought area, again came and took support at 40. That means it is an 40 is an oversold area for the bull market, and this was enough to tell me that the RSI is not carrying itself to the oversold area again. Now that is a strong trend is about to emerge. Again at C it came down and took support at 40, then carry to the oversold area, and it told me that it is making a base here. And suddenly the trend started to move upside, and it took support at 60. It took support at 60. Again it moved up, took support at 50. That is the neutral zone at E. Again it moved up and took support at F. It is the 700 points. And now everybody knows what happens to Auropharma after this. It went up. Now one observation you can make out here, that every time there is a bounce at 60, that means that tells us the trend is more strong on the upside. It's not like that, right? This is an observation from this range shift. All right. Now this is a weekly chart, and you see 40 support, prices went up, then 60 support, prices went up, came down, neutral zone, again went up, came down to the oversold zone. Again this move didn't carry to the oversold zone, moved up, again came down, and now at point D it is not able to carry itself above 60. At point E it is not able to carry itself above 50. At point F it is not able to cover itself above 40 or above 50. So from a range of 80 to 40, there is a shift to a range of 60 to 20. If you draw a box, you can understand. Similarly, in the monthly chart, you can see there's a 60 support, there's a 40 support, there is a range shift, and this is boom. And now it came down again and moved up again. Now at this point it is not even able to cross 60. That means this is just a mere correction. Point D at which chart? Just a moment. Yeah, this point D. All right. So how to trade range shifts? This is our second trading setup. Spot the range shift signal on the chart. This gives us direction into the trade. Spot the entry, take the trade when it is confirmed by the price action, that is the candlesticks or any price chart. If the move continue past the second range, it is the confirmation that the change of direction. If not, plan exit accordingly. I will explain you what is this. And also watch for the neutral zone support and resistance. Now this is an important catch. If the move continues past the second range, it is a confirmation of the direction of change. If not, plan exits accordingly. I will explain you what it is. Everybody will tell you what is range shift. Everybody will tell you how the range shifts, but nobody will tell you how to trade range shifts. Because this thing they don't know. They don't know this point. I can challenge you. रेंज शिफ्ट सब दिखा देगा आपको चार्ट पे. रेंज शिफ्ट कहां हो रहा है, रेंज शिफ्ट कैसे हो रहा है. बस रेंज शिफ्ट ट्रेड करना कोई नहीं दिखाएगा. Now let me tell you how. Suppose here after a fall down, it moves up and takes support at 40. It has taken support on 40. All right. Now it moves up and it has passed 60 here. That is the second range. First range is 40 and second range is 60. it has passed 60 year. This is the confirmation that the range has shifted. Moves down again, moves up, that is we have taken, RSI has taken itself above 70. The same funda, price move up is taking RSI in the overbought zone. Again it moves up, it takes you into the 70 zone. That means the price have taken up you into 70 zone. That means this is the confirmed range shift. Watch here for resistance. Now what happens if price shifts range here at 40, moves near 60, take resistance and moves down again? It shifts down again. That means this is not a range shift. If you have entered here at 40, you should exit here at 60. As simple as that. A move from year to year. It's not a bad move at all. Let me explain once more. If you have entered at a 40 range shift, the prices moves up and goes into the overbought territory, then it is a confirmed range shift. You can buy the dips to the neutral zone, you can buy the dips to the 60 zone, as long as the price is taken to the overbought territory. But somehow the range at support, taken support at 40 and somehow it halts near 60 and moves down, and it is not able to go to the overbought zone. At that moment you should understand that this is not a range shift, this is just a correction, and you have to book your profits here. Hope I am making myself clear. This thing nobody will tell you. Self-proclaimed RSI gurus on the internet, everywhere, nobody will tell you these things. So let us do an example here. The price were in the overbought zone. At 0, the price fails to move to the overbought zone and also shifts range at 60. The price comes down, moves up at 1, again taking range shift at 60. That means 0 and 1, the price took a range shift. At 0, we got a confirmation that the momentum is not extending to 70 zone. That means there may be a trend change. At 1.1, we got a range. At 0, we got a range shift, but at 0.1, we also got a confirmation that this is a range shift. Then move down, that again up at 0.2, nearly a neutral zone. Then at 0.3 moves up, not even able to cross 40. It moves down again, and here you can see that if you see that there is a type of range shift. You go long here, but as soon as the price moves and is not able to cross 60 on the upside, you understand that this is a correction, this is not a trend change. You exit your position here and you can easily go short. Then again it comes down, takes up to the neutral point near 60. Again it comes down, take us to the neutral point near 50. Again it comes down, take us to the neutral point, take us to a very this point, that is 7 point, taking resistance as 40, very weak. Again come up, take resistance as 40, again very weak. Now it goes down, down, and then we move up. So just imagine a entry at 1900, 19,000. One lot, 40 units. And an exit at 14,500. This will be your stop loss, swing highs. 5,000 points in Bank Nifty. As simple as that. Following only range rules and overbought, oversold funda. Now if I stop here today and if I wrap up the RSI course here today and I don't teach you anything in the next session, even if you follow this method consistently, you will earn money. People who are with us in our pitch service, they know how we do it. All right. So this was a very easy setup. So we'll do one more setup today. That is the RSI power setup 3. We have done one overbought and oversold. That is the momentum setup. Second setup we did was an range shift method. How to trade range shift. And this is the third method setup we are going to trade. We look for a momentum surge over the bullish or the bearish extreme. That means when RSI moves beyond 60 or it moves below 40, it's a momentum surge. It signifies bull or bear power into any contract. Once the RSI moves beyond 60-40, the entry is done above or below the high of the alert bar. Stop loss is swing low and high. And when the positions are in profits, exits can be planned at the neutral zone 50 or trail profits to the swing lows. I'll just explain you on a chart what this setup is. We call this the momentum surge method. One single tool and how you can use it in trading in various different ways. So this is the 60 level and this is the 40 level. Once the RSI crosses the 60 level, at this bar RSI crosses the 60 level. So we call this bar as our entry bar or alert bar. Next day or on the next hour, we will mark the high of this bar, and if the close is above the high of this bar, we will buy, and then goes the trade. All right. Now there is one method you can put stop loss is swing low will be your initial stop loss. As it goes up, you can trail your stop losses at various swings. Right. Now, how you will book profits? Once the RSI comes and crosses 50, this become our exit bar. Once RSI goes below 50 and a bar is closed below 50, this become our exit bar. Now at the red arrow, the RSI has punctured the 40 levels. So this bar at which the RSI has punctured the 40 levels become our alert bar. Now we will put a sell order below this bar. The sell is not triggered and the initial stop loss will be here, the previous swing high. The sell is not triggered, moves up and the sell is triggered here. Once the sell is triggered here, we will trail our stop loss to the previous swing highs. It moves down, again it comes up, moves down, we trail our stop loss to the previous swing high and it crosses our stop loss swing high and we exit, whichever occurs first. Either the stop loss is taken out or the neutral zone is breached. Whichever occurs first will take our profits. Then here the RSI again breaches the 60 level. Here we set our entry bar. We set our entry above the high of the bar. On that day, the RSI don't crosses above the high of the bar, so there is no trade. RSI moves down again, so we are not taking any trade. All right. A simple technique, a day trading technique. You can use it on hourly charts. A simple day trading technique. No rocket science. Okay. So this was our setup number 3. So we have learned 3 trading setups. Now the 4th trading setup. The RSI settings, set it to 2 period. Instead of 14 period, you have to set it to the 2 period. Then you have to plot 5 period simple moving average and 200 period simple moving average on your charts. This is done only on daily charts and no other time frame. Please note it down. RSI settings at 2 instead of 14. You plot 5 SMA on your chart, you plot 200 SMA on your chart, and when you go long, price should be above 200 SMA. Number 1 condition. Number 2 condition is that price should be below 5 SMA. That means price should be above 200 SMA. That tells us that the long-term trend is up. And price should be below 5 SMA. That means there is a short-term correction in the long-term trend. Condition number 4, that the RSI should be below 20. That is, it should be in an oversold area. 3 conditions are fulfilled. First, 200 SMA, the price should be above 200 SMA. Second condition, the prices should be below 5 SMA. Third condition, the RSI should be below 20. If these 3 conditions are satisfied, then you can buy on the open of the next day. When market opens, wait for 1 or 2 minutes, 3 minutes, let the dust and the volatility settle down and then you can buy at open and take profits when the RSI crosses down the 5 SMA. Means this will be price, sorry, changes to the price. This is not RSI, this will be price. So when we take profits, when the price crosses down the 5 SMA again, right? Rules for the short is just the opposite. Let us see on the chart. So this blue line is the 200 SMA. This red line is the 5 SMA. At this point, the RSI is below 20. The prices are below 5 SMA. All right. First condition, the prices are below 5 SMA. Second condition, the RSI is below 20. So next day, at the next day open, when this candle opens, we buy at the open, and if you want to set a stop loss, you can use the next day previous day low as the stop loss. So we buy at open and the prices moves up. When we take our profits, when the prices come down and close, when the prices close below, when the prices crosses the 5 SMA again, we take profits. This is a very short term technique and it's a very effective technique, and it is used on a daily chart only. And one more recommendation, I would request you to use this technique in trading Nifty or Bank Nifty only. Not even Bank Nifty, only Nifty. Because I myself do this trading technique on Nifty. And the results are amazing. Alright. So let us see a shorting technique. So 200 SMA and 5 SMA. The prices moves above the 5 SMA here and the RSI is above 80. 20 was for the long and 80 was for the short. Alright. On the next day, you can use it in options, you can use it in futures, anything you want. On the next day open, we sell it, and here is our stop loss. The price drifts down, no closure above the 5 SMA, and here the prices close above the 5 SMA. We exit our position. We sell at near 5,100, somewhere near 5,100. We book profit at 4,600 or 4,700. 400 points in Nifty. Just can you imagine 400 points in Nifty, and that too in 15 days? And believe me, this is just the basic course. We have an advanced course and we have another course that I don't teach. I have discontinued it. And what the hell we do with markets, you can just imagine. Trade in Nifty, trade in Bank Nifty, any stocks that is less volatile, you can trade it there. It's a short-term trading method and a super trading method. And we are using only RSI in our trading. The first question participants asked me, sir, is it possible to trade with only RSI? Yes. Now they understand that how we are able to trade only with RSI. Commodities, you have to back test, you have to paper trade, because I have discontinued trading commodities from a while, and I don't know because I am more interested in trading stock markets. So we rest our topic here today, and there is little bit left, that is divergence and how to trade with divergence, and then reversals and how to trade with reversals. Profit setups, trend analysis checklist, that we'll do in the next session. That we will do in the next session. So we rest our topic here today, and this session is being recorded. I will send you the recording maybe by today evening or by tomorrow morning. You can watch it there and revise the fundas. Try to paper trade first. Get some confidence in using the setups and using RSI. Don't jump in with real money. Get some confidence. Make yourself comfortable with the stop loss and target points, and then only go and trade. I would strongly recommend you to paper trade for at least 2 or 3 months with RSI, and you get your comfort level in, and then go in and trade with the real money. All right. So this is the first session of our power trading with RSI comes to an end. Next week, maybe a little bit early, we will do our second session, because next week I have to take up an advanced RSI course also. So next week we will finish our power trading and we'll finish our advance also. Advance won't take more time, and so next Sunday we will wrap up our things. So till then, happy trading. Have a good night. Take care. And thank you for the feedback, and bye-bye.